Welcome to today's episode. We are diving into the psychology behind trading success, the realities of prop trading, and how the trader's profession is evolving. Joining us is Nicholas Quinn, CEO of FTUK, a company working directly with funded traders worldwide. Today we are talking about why most traders fail emotionally, what prop firms actually look for, and how technology is reshaping what it means to be a professional trader. Let's start with the foundation of everything in trading psychology. First question, Nicholas. From your perspective, why do most traders fail emotionally even when they have a solid strategy in place?
Apparently because most people are not trained how to think. As human beings, we don't tend to grow up learning how we think, particularly emotionally. And human beings, they don't make decisions well in uncertainty. We don't like uncertain environments. And particularly when those decisions that need to be made are under pressure. And of course, you get a lot of that in financial markets. So what we do is we use a field of study called heuristics. And heuristics are very small mental shortcuts, rules of thumb that allow you to arrive at a decision quickly when you are faced with a very complex situation. And in financial markets, there's obviously a lot of decisions that need to be made under pressure, but because we don't have a lot of experience in understanding how to make quality decisions, the heuristics that we use, they always are built on our belief system. And our belief system when it comes to money is always a product of our upbringing. And that's where the complexity starts. So no matter how good your trading strategy is, you'll always be seeing your decisions through the lens of how you see money emotionally built from your childhood. And what that does is if you keep walking down that road, you'll always start to develop bad habits unless you're able to stop and identify what those core issues are that you're having and actually sort of like make steps to fix them. And so you can give someone a good strategy, and if they've not figured out that psychology, that the way that they make those decisions in the market, they'll always start to just wander away from the strategy. So you could argue that trading psychology, fixing your bad habits, and it sounds very simple, it's not very easy, but fixing your bad habits is pretty much in a nutshell what you need to do. And that's essentially why most people fail emotionally at trading.
You know, Nicholas, being a trader myself, I can't agree with you more. So I do like your question. I do like and agree with your answer. Which psychological traps, such as FOMO, overconfidence, or revenge trading, do you see most often amongst traders? And which of them is the most destructive in your experience?
Yeah, so there's a number. There's obviously a lot of cognitive biases that affect us in markets. The two worst are FOMO, fear of missing out, and also revenge trading. FOMO because it erodes your confidence very, very quickly because you're always feels like you're out of sync with the market. And revenge trading because that's the worst financially that we see with prop traders because that just decimates people's accounts if they end up in the wrong state of mind. So the interesting thing about something like fear of missing out, FOMO, is that you are ironically, emotionally, as far away as it's possible to get from the actual execution of your trading strategy. And it's because, I used to call it in markets, shiny objects. So you get the idea that when you see the market open, the US Open or the London Open on a very fast time frame, and the market leaps forward, and everybody that you're surrounded by in your trading forum or whatever is jumping, or they've got the perfect entry, and you're not involved and you want to get involved. That shiny object makes you leap forward and jump in and buy the market. And that quite often, the compulsion to do that doesn't necessarily give you the results that you're looking for as you're trading. So an example would be if you look at the metals market at the moment, a market like gold is just runaway. And there's a lot of people sat on the sidelines, not involved in that. So people that are in that market shorting, trying to find the top, they find it very, very difficult trying to do that because they suffer death by 1,000 cuts. But then people that are trying to get long, they find that very difficult as the market really starts to take off, because once they jump in at market, they've got no way of managing their risk. So the way that you start to combat fear of missing out on a trade is to really think about the mechanism that's actually pushing you into making that decision. So I want you to imagine you see a market that really takes off. Everybody knows, and you'll know yourself from being a trader, you feel that compulsion to hover your mouse over the buy button and just join in at market, and then you'll figure it out later on. Usually there's two bits of that decision, and the second bit is once you're in the market and you've committed, oh, where am I going to put my stop loss? That bit usually becomes as an afterthought. If you think about that process and you're able to resist jumping in the market and then think where that stop loss placement would be, a fantastic exercise for combating fear of missing out is to then place a limit order in that area of the stop and force yourself to stay out of the market and let the market then play out. And you will be staggered at how often you see the market at some point retrace and then provide you a better opportunity that shows you a positive result. You start to put a string of those together, and then all of a sudden you start to see that the market can give you something better. You can actually use the fear of missing out on something instead of reacting to it. Use that reaction to help you build a slightly better framework. That in itself is not a money-making exercise, but it's a great way of understanding how you behave in an environment where you think you're missing out on something. With something like revenge trading, this is probably the worst thing in terms of what blows people's accounts up. That's really our inner child. That is our inner child in the playground at school that's stomping its feet, that's throwing a tantrum, and you're completely disconnected from what's going on in the market. Now, the way that revenge trading works is it's very similar to if you were to imagine that you put a frog in a pan of water and put it on the stove on a stove. The frog doesn't know that it's in danger until it's in danger and it's too late. And it's exactly the same when we are revenge trading. We don't know that we're a revenge trader until we're deep in the hole and it's now impossible to actually get out. So what you've got to do in a situation where you've got someone who is doing a lot of revenge trading, you've got to help them understand where in the process it actually starts. And it's usually much further back than most people realize. So what I want you to imagine is that most people would think that you become a revenge trader because you took a loss. It's actually, that's not the case. It's usually, it's being proven wrong after you've been proven right. So if you put together the most amazing sequence of trades, you're completely in tune with the market and everything is going great. And then all of a sudden, the market then disagrees with you and snatches that away. That's the point. That's the inner child that suddenly had taken something from them. The market has done something to you. That's usually the tipping point when someone starts to become a revenge trader, and that's the point that you need to intervene. Now, there's a very simple fix for how you can tackle revenge trading. And what happens when someone starts to revenge trade and they can feel that the trading is getting worse and worse as time goes by? What they do is they tend to end up in a situation where they're very binary. So they're jumping into the next trade and coming out. It's either all in or all out. And that is what starts to hemorrhage the equity. So what you do is you build a framework in someone's strategy where they have to scale out of a loss. In a losing situation, particularly after it's gone very well, you must start to scale out of the loss rather than come out in one go. And what that does is it forces you to stay with what you've got mentally, but actually sort of progressively take the losses rather than going in and out all the time. And what that does emotionally, that creates a sort of pillow under your decision-making process. And that in itself can be a way that you can start to soften the way that someone is on that pathway to becoming a revenge trader. These are all the kinds of trading drills that you can very slowly develop, but it's the execution of those and the practice of them that really makes a massive difference.
You know, Nicholas, I always say, don't chase the trade. Let the market come to you. And the hardest thing, it seems, that it's to wait, to being disciplined. And, you know, it's great that you share the tricks how to achieve that consistency, even when you are fearful, when you want your revenge trade, because I think you and myself also went through this experience. I know what you're talking about exactly, and I'm sure that it will be extremely useful for any new trader or even with some experience. How professional traders build resilience to stress and drawdowns.
To build a sense of resilience in the market and to cope with the stress when you're drawn down and you've still got to perform at a high level. I mean, you can't get away from the fact that experience is always going to be something that's going to help you in that capacity. You're always going to be a better horse rider if you've fallen off the horse at some point. And everybody that's trading is going to need to go through that journey somewhere along the way. But what we tend to find at FTUK is that the guys that are really good, the professionals that sort of, understand what they're doing in the market and understand how they're executing their strategies, they're very good at breaking their trading down. And I don't necessarily mean that they're good at isolating a core bit of their strategy. What they're very good at doing is breaking down how they approach the market, drilling certain aspects, finding the bad habits. They say, I never really hold my trade to target. Why is that? Because it's costing me a lot of money. I'm leaving a lot of money on the table by coming out of the market too soon, or not holding to target. People that are able to look at those situations and break it down, turn it into a trading drill, and then start to benefit from seeing how they're able to change that behavior and do that with every aspect of their trading. What happens when you start to do that, you start to see the positive outcomes. That's where you start to enable yourself to sort of see some release in stress. And as you're in a situation where your equity is being drawn down, it's not as much of a big deal because you've got the confidence from the competency of seeing what it's like on both sides. That's how they do it. That's really the way of doing it. And the way that you've got to get there is by stop trying to make money just using the market as a vehicle for just making money there and then every single day. And if you are, well, and that's great if you are actually successful at it, but if you're still learning and you're still having problems, then just removing that money aspect and actually focusing on the execution and the trade and the way that you're doing that, that is the way that you start to benefit as a trader and grow. And that then is where you're able to cope with stress much more effectively.
Nicholas, you just mentioned that money factor. And I also, realized that as soon as your main goal, your target changes to moving towards perfection rather than getting a pile of money, you start to be consistent. So this is exactly, I think, what most traders need to do. And there is another trick I recommend usually, is if you have $1,000 on your account, put this $1,000 next to your monitor and just look at it and say, if I lose 1,000, this is what I'm gonna lose. This is actually, because when you see just these digits on the screen, it's kind of trick, it's a mind trick because you don't really believe that it's real money, but when you can touch it, you realize that the risk is real of losing this pile of money. 1,000, 10,000, whatever, it doesn't matter, but it still makes you realize or see the reality of losing.
Yeah, you've got to be able to separate the money aspect from your execution and your ability as a trader. Someone who plays the piano can sit down and play a tune or can play a song or can play some music, but there's a big difference between a piano player that improves their technique by practicing their scales day in, day out. They're still sitting at the piano, but they're not playing music, but they're using the facility of what they've got in front of them to improve. And then the music is the end result in the same way that money is the end result that you get on your trading account. And the great thing about trading these days is that you can do that. You don't have to sit there and just try and sort of be a hero all the time and go for the big win. You can use demo accounts, the technology. A lot of it is free these days. And you can use that to sort of improve your ability in all different facets of the market in your trading. And that is an amazing quality that we have these days in financial markets.
It's true, because the trading is a marathon rather than the sprint, and you have to look at the distance rather than create this illusion of getting rich within a month, because most people actually dream of money, but this is exactly what ruins the deposit. What is the psychological difference between trading your own money and trading firm capital? And why is funded trading often more mentally demanding?
It's really because the biggest difference really between trading your own funds in a brokerage account and then trading prop is accountability. It's a lot more pressured in a prop environment because you have rules. You have rules around what you can and what you can't do. In a brokerage situation, if you're going to take $5,000 of your own savings and put it in an account, they'll give you some leverage and you get left alone and you can pretty much do what you like. The moment that you move into a prop trading vehicle, a challenge, a funded account with a prop company, you can't just do whatever you like. You have to work within the parameters that are set, and people think that is restricting. It's actually quite liberating, because what it does is it provides a framework where you're being watched, where you're under pressure, where you can't just sort of like pretend that you're doing one thing, but in reality you're doing something else, because that prop account is rigid. It has a certain framework attached to it. So what prop trading does is it really moves people away from their comfort zone. It sort of makes the market more accessible from a price point as well for most people, but it also takes you away from your comfort zone, and that's where you get good growth. So what prop does that's different from brokerage accounts is it helps people grow much faster, because you have to deal with the situation. You have to deal with the fact that you've got a drawdown in your account and your equity is sort of like not far away from that, and you've got to work with the situation that you've got. Not as it's a lot softer in a retail brokerage account. Now that is a good thing, because what it's doing is it's breeding a generation of traders now. They think risk first. When I first started and you opened a retail brokerage account, you could put some money in, and risk is usually the last thing that you thought about. You thought about your exit, you thought about where to join in the market and how much money you were going to make. Risk was always kind of thing, that's the boring bit I've got to do. What we find these days, people joining, risk is the first thing that they think of, because you have to in a proper environment. So that's the biggest difference, but it's no question, it's a very, very good thing.
You know, Nicholas, I think that this restrictions in the risk and all the rules is actually a great help for any trader, because they know the rules. They know that if they break it, they're gonna lose the capital, and the risk itself is low. So they learn to be disciplined, to stay within the certain risk. And there is a lot of benefits. It's like a small teacher. Any prop firm teaches you that discipline. So I think it's a great way, even for beginners, to follow the rules, because if you don't, you're gonna lose that capital. If I would be a newbie, 100% prop firm is one of the great ways to improve, not to start, but to improve. When you are successful already, somewhat, it's a great way to move forwards. It's a next step. So yeah, agree with you totally.
Yeah, I was just going to say, because you can work in a safe way in a prop environment. If you've worked for several years to build up a nest egg, maybe it's a deposit for your first apartment or your house or whatever, or you decide to take some of those savings and allocate them into a brokerage account, and you lose it all because you don't understand leverage and you don't understand what you're doing. I mean, that's pretty serious. Prop allows you to experience what that's like, but you can do it in a safe way because you're never betting the ranch. How can that not be a good thing?
What are the most common mistakes candidates make when trying to pass prop firm challenges?
Very easy to see in people's trading accounts. It's usually things like overtrading. Overtrading, you look at someone's account, they've come in at a very high level. They've no relationship with the prop firm. They've gone for a big 100K instant funding account, something like that, or 100K one step, and they've got 3 days in, they've got 1,000 scalps on gold. That kind of thing, that kind of incessant over trading, that's a very, very common mistake. And it's really because people don't really understand what they're doing from the get-go, particularly if they're only just starting, because it makes total logical sense to just sit there and just keep clicking the button. So it's usually things like that, or trading too many assets. You know, you look at someone's account and they're trading every single market under the sun, or you know, the old classic, which is not reading the rules. And that's very, very common that most people don't do it. All prop firms will have a whole myriad of rules, but all prop firms will detail all those rules on their FAQ sections, somewhere on the website. So it's a common mistake is people come in, they buy the account, but they've not absorbed all of the criteria that they will have to follow, and they'll sort of figure that out as they go. It's absolutely imperative that you read the rules on the FAQ so you understand everything that pertains to your account. That is a very, very common mistake. Another one is people expecting the prop firm to essentially hold their hand through the entire process. And what I mean by that is the prop firm is there to provide a framework and to provide access in a fair way. So people that are expecting the prop firm to sort of nudge them in the right direction, that is something that is a very common mistake that many people make. And people that take on too much risk the maximum amount on their position sizes all the time. Just because you've been given a Ferrari doesn't mean to say that you need to get into it and drive at 200 miles an hour. So it's one of those things where you've got to really step back a little bit and take your time. You get a lot of firepower on prop accounts, but you don't need to use all of that capacity right from the get-go. So it's a very, very common mistake that a lot of people will do.
You know, Nicholas, it seems that all these mistakes coming from the simple lack of discipline. You know, it seems like that, you know, and for me, it's like that. And as soon as you have a solid discipline that you follow, I think all these mistakes can be avoided. Don't you agree?
Yeah, a lot of discipline and a lack of understanding of how you are going to be working, how you're going to be executing trades in the market, and education, because from an educational perspective, retail trading has a fairly decent amount of education, and you shouldn't need to pay for a lot of trading education these days. But when it comes to prop's a little bit different. The educational component of that, I think, is still a little bit lacking. And it's usually how you take all of that stuff from understanding a market, understanding a strategy, understanding how to put together a profitable equity curve, but then relating that to a prop firm so that you can get the most out of your account. I think that is something, that educational component is something that's still lacking a little bit at the moment.
Looking ahead, how do you see the future of prop trading in terms of regulation, transparency, and sustainability? What will healthy prop trading look like in the coming years?
Prop trading itself, I think, still is going through an evolutionary phase. There's a movement now to connect prop firms with brokerages. I think that's a very, very good thing. How that gets shaped, I'm not exactly sure yet, but it's possibly something to do with how brokerages take on a prop firm, or a prop firm takes on a brokerage, and one feeds clients from one into the other. And that opens up all kinds of different things that will benefit clients over the longer term. Maybe there is a new way of searching out people that are very, very good at trading, because we do have a lot of extremely good traders in a lot of these prop firms. But from a regulatory point of view, there's still a bit of a mismatch between what you are able to do in a prop firm versus what you have to do in a brokerage, and that still needs to be lined up. I think that regulations are possibly maybe just around the corner now. Certainly within the next 2 years, we'll be starting to become a fully regulated industry, and I think that's a very, very good thing. It's going to help on all kinds of different levels, from a KYC perspective of understanding who the client is and the compliance that goes along with that, and anti-money laundering rules as well. That would sort of like help sort of the industry as a whole. Transparency in terms of pass rates or payouts and that kind of stuff, that can only be a good thing to help build the trust that's lacking a lot sometimes in this type of industry that's still going through that evolutionary phase. One thing I think that regulations should do and will do within the industry is just make the barrier for entry for people that are setting up prop firms just a little bit more robust. That framework, I think, needs to be looked at, simply because one of the key things that the prop industry has found is that the trust is very, very fragile with clients, and that's understandable. But you have a lot of new firms being formed every month these days. So there's a lot of new prop firms over the last 18 months. And they tend to be sort of like created by a lot of people that have got a lot of understanding of how to sell how to create the websites and the products and the tech side, and understand social media and understand how to sell stuff and stuff on online, but not necessarily have the most completely well thought out business model. And when that tends to sort of like get further down the pipeline, if the finances get out of control and the firm cannot sort of like, stand behind those payouts, of course, that's where the trust goes. So I think regulations being able to bolster that bottom end of it so that the trust can be there for the clients, that they know that when they're dealing with an established firm that's got the right backing, that's got the right firepower and liquidity, that they know that the complete circle of buying a challenge, successfully passing it, and achieving a payout, and then getting where you want to go. I think that's essentially what the regulations will help with.
Thank you, Nicholas. That was very informative for me personally, because I'm not that much into regulation, but I know it's getting very tight, and it will be getting even tighter, if you know what I mean. But those firms that are getting ready for this increasingly strong regulation, I think, will survive and will flourish in the coming years. How have prop firms reshaped the trader's career path, and why has prop trading become a real alternative to trading personal capital?
Because it's really widened the net. That's essentially what prop trading has done for so many people. And if you are on the pathway that you want to become a professional trader, if it is going to be part of your career, there is no better vehicle now than having a prop that you can use to run alongside that. We have a lot of student traders, and they're doing economics degrees, they're doing mathematics degrees, they're into finance, they want to get into finance, and they're all running a prop account alongside their development. So it dovetails very, very beautifully with people that are taking that step to become a financial professional. And that's something that the FTUK supports an awful lot with a lot of our guys that are students. It brings the age limit down as well. So, because a lot of stuff is, is done through your phone these days, prop in itself is so accessible now. The market is so accessible to everyone. And it's not necessarily where you are geographically, it's where you are financially as well. You can get access. And that is something that prop has really had a pivotal role in reshaping. And what you'll find that people will use prop for when they're getting into it from a career point of view is they'll use the track record that gets created with their prop trading as a benchmark that they can use as part of their career journey. And what I mean by that is, because prop trading is quite challenging and people will have to work very hard to actually achieve where they want to go, that creates a verifiable third-party record of how they work financially, how they deal with different market conditions that no one can argue against. That's immensely valuable to people that are stepping forward in their career and using prop as part of their way of getting into finance and becoming a professional.
How has trader education and preparation changed, and what does it mean to be a professional trader today?
I think it really depends on what a professional is defined as. I mean, certainly I think from an institutional point of view, someone who is a trader in like a commercial bank, it's still an execution role. They're not necessarily trading the markets for a book. They're not trading for necessarily speculation. They're helping big corporations hedge their risk. So from a professional point of view, I think that route it still remains the same. It's going to be someone who is going to be studying for an economics degree. They're going to get qualifications, going to study the industry. They've got to sort of like develop their own trading experience. And that, I think, has not necessarily changed. Where I think there's a lot of crossover and a lot of mix up at the moment is that the way that social media and influencers and the way that the prop as a modern day fintech solution has been married together with social media. I think that's where a lot of it is sort of become very confusing. So quite often you'll find that a lot of people that will say to their audiences on Instagram and on TikTok that they're professional traders, it's only part of the profits that they're making in markets is only part of what they're doing as a business. It's usually far more connected with affiliate marketing and sort of deals with sponsors and influencer type business models. So the prop in itself is only one component of that.
Nicholas, technology, data, and AI have transformed market access. Why does data overload often lead to worse decisions, and which tools actually help traders today?
The tech is great. What you get in liberation, in ease of access, and you can do everything so easily these days, there is a component of that that makes people take a lot of it for granted. So it's really an important lesson to always remember that it's actually not that long ago that we didn't have trading online, where it was done on a phone. It's not long ago since we had times where if you wanted to get charts, you had to subscribe to a mailing charting service where they would send you hand-drawn charts through the post. That did actually exist. And what tends to be forgotten is that so for example, if you had to draw your own charts by hand, that would be immensely difficult for anybody to do these days. And it certainly would mean that if you were working on an intraday time frame, you couldn't do it. But you go back and you go to a library, or you go to any old trading books, they all have hand-drawn charts, and they're all done on daily time frames. So if your only reference point was to look in the Wall Street Journal tomorrow or the Financial Times to pull out the open, the high, low, and close on gold, and that was your information, and you recorded that, that would make you feel and think very, very differently about how you approach the gold market, because there's a connectivity that you've got there by being fully invested. That with the technology has just reduced all of that completely, because it's just there and you don't need to work for that. It's just there. It's just given to you. So I think that we have sort of lost a little bit of that. And one of the things that you can always try and do is remember that with anybody that's learning to trade, going back historically is always going to benefit you just as much as working with the modern tools that we've got and using those. So to give you an example, a lot of the popular indicators that a lot of people use on their charting packages, RSI, Bollinger Bands, ADX, those kinds of things, all of those indicators, like particularly the Wells Wilder stuff built in the late 70s, that was all built for daily timeframes. That's the reference point for that. That's really useful insight on how indicators are potentially sitting in the most effective zone. But of course, what a lot of traders will do on the apps and on the charting platforms is just take all of that framework and dial it into a fast time frame because they can. So it's one of those things where you can benefit as a trader simply by having a better perspective. When it comes to things like the advent of AI, this is a very, very common talking topic of no one's really figured out how that's going to work from a prop trading perspective. I mean, what we're working on at FTUK these days is the way that AI, I think, is going to really help benefit traders moving forward, is that the prop model will probably become more tailored. So we will get people through the door. We will analyze using machine learning how they want to work as a trader, what their tolerance to risk is, what their ideal account size is, what their their markets are into, what their market interests are, and we will use that data to help sort of maybe tailor a product for them, specifically for them, so you can sort of bring the right vehicle to the right kind of personality type, and that is something that will really benefit the trader moving forward. That's something that we're working on at FTUK, and that's something that I think will be a really good use of AI moving forward in this industry.
So Nicholas, what would an average trader needs to do? How he can use FTUK? Maybe you have some offers, some giveaways, how to get involved with your firm fast and effectively.
Yeah, I mean, this we have a lot of offers that run all the time. We put something together specifically for Traders Union because we're obviously very grateful to join in on the interview and work a little bit more closely with you. So for viewers and subscribers to Traders Union, if you go to the FTUK website on the checkout and you use the code TU30, then we've got a big discount on all of our Forex accounts, our instant funding, one-step and two-step challenges. So 30% discount, and you get a free account with your first payout, which is a BOGO offer. So it's a BOGO offer for all our Forex accounts with a 30% discount on your first payout. The code is TU30.
Thank you, Nicholas, for sharing such a clear and honest insights. It's evident that modern trading goes far beyond charts and strategies. It's about psychology, structure, and adapting to an evolving industry. This conversation shows that the future belongs to traders who can combine emotional control, discipline, risk management, and smart use of technology.